So in this video we will look at the bank's balance sheet, a typical bank's balance sheet, and we'll also look at 2 reasons why banks fail. This is rather important because what banks do is quite remarkable. They transform lots of short-term deposits into long-term loans, lots of liquid deposits into illiquid loans. And this balancing act can cause difficulties, even though it's of course useful for the economy, for economic growth. Let's look at how banks make a profit. So banks make a profit because of the interest rate spread between the average interest rate on loans and the average interest rate on deposits. As long as loan 1 is higher, there'll be a difference, and therefore the bank can make a profit after paying its costs for its shareholders. So banks are there to make a profit, commercial private banks anyhow. And let's look at the bank's balance sheet. The balance sheets have to balance because of double entry bookkeeping. So the assets at any one point in time will equal liabilities, and the assets are what the bank owes, and the liabilities are what's owed by the bank. Okay, so what is owned by the bank are all these assets here. Well, let's start off looking at the asset side, and then we'll look at the liabilities. On the asset side, the key thing, of course, is cash. You deposit your cash in the bank. Indeed, you trust the bank. Trust is a very important word. You may wonder why banks in the 19th century have amazing Victorian buildings. And that's to make them look solid and secure. You want the bank to be solid and secure. You trust it with your cash. And what banks do with that cash is they loan it out with unsecured loans, and they give people mortgages. Basically, they don't keep all the cash, because what they rely on is that not everybody who puts cash in the bank is going to take it out all at once. So not everyone's going to take out all their cash at the same time. If they did, there would be an almighty disaster, because there'd be a run on the bank. And a run on the bank is when depositors panic because they lose trust in the bank, and then the bank has a liquidity crisis. So the first reason why a bank can fail is due to illiquidity. It cannot meet its liabilities. It owes that cash to you as a liability, and if you and all the other depositors try and remove cash all at once, then it will be in a liquidity situation pretty quickly because of a run on the bank. And so in that case, the central bank acts as lender last resort and will protect the depositors. Okay, so that's the first reason why a bank might fail, and why the central bank might come to the bank's aid as a lender of last resort. Other assets then, we've got most liquid, we've got cash. And as we move up these assets, they become less liquid, but more potentially profitable with a greater rate of return, and indeed potentially more risky. So you see, for a bank, there's a tricky trade-off between profitability and liquidity. You lose liquidity but gain profitability. So as we go up here, we've got balances at the central bank. Well, that's very liquid. You can get that back instantly. And the Bank of England and other central banks require banks to maintain balances at the central bank. Money at call, short notice. This is just short-term lending to the money markets, to other banks. You can get that back very quickly, within hours, probably less. So this is all highly liquid, okay, this part of the balance sheet. And indeed, commercial and treasury bills, if these are owned by the bank, these are pretty liquid. If you can sell them quickly in the markets, but you won't necessarily get a guaranteed value for them. So in that way, they're slightly less liquid. And the same with bonds the bank may have. Okay, these are less liquid still, because again the price of bonds would vary more than bills, most likely. So, and then we come to two types of advances. Banks give out loans to individuals for consumption, okay, and they also give out loans to firms to set up new firms. Now, unfortunately, when firms expand, and particularly when new firms are established, they are pretty risky, and this is quite a risky loan. So there's the danger of a default on those loans, okay? They're unsecured loans often because there's nothing in terms of security set against the loan. So if we take a mortgage, banks like mortgages, they get pretty good interest on the mortgage, and they can secure that mortgage, of course, with the property. So if you default on the mortgage, the bank can repossess the property and sell the property and get a lot of the mortgage back. Mortgages are pretty profitable, good rate of return, but even more profitable, but more risky, of course, are unsecured loans for new businesses or perhaps for individuals. Now, the bank obviously owns some fixed assets, such as its building, maybe land, and these are relatively illiquid because they'll take some time to sell a loan. Yeah. Okay, so that's all our assets, and on the liabilities side, okay, we've got the deposits that we mentioned. So there's a mixture of what we might call current accounts and time deposits, such as savings accounts. Okay, short-term lending from the money markets, so that's money that comes in from other banks and the money markets. And you've got long-term borrowing is another liability, such as bonds that are held in the bank. And then finally, this part here, we've got share capital, and the share capital is a liability because people who buy shares in the bank may want to sell their shares and get the shares back. Also, the profits from those shares are retained earnings, but ultimately, if there's a problem, the shareholder may want those reserves back. So the second reason why a bank may fail is because of insolvency, because of insufficient capital. So if the assets of a bank fell in value, and suddenly you ended up with this situation where the assets were worth less than the liabilities, the bank will be insolvent and it would have to close down and it will become bankrupt. And what we'd have to do is to meet as many liabilities as possible. And the reason this could occur is because the bank issues too many loans that end up going bad, so end up with a lot of bad debt on unsecured loans, and they can't get those loans back, then obviously the value of our assets will fall, but they still have to meet their liabilities, and therefore the bank is wound up. Accountants come along, pick along the pieces, and give what is owed back to the people whom it is owed to as best they can. And so, because of loan defaults and bad debt, that's a second reason why banks can become insolvent. So there's a spreadsheet and two key reasons why banks can fail. So thank you for watching.